Welcome to video T7E on amortization, which is really just depreciation for intangibles. Since you should have some of the computational basics down, this video is a little less calculator happy. Let's get started.
Intangibles are forms of property that cannot be touched. This includes expenditures for organizational costs and startup costs. Intangibles such as patents, copyrights, trademarks, and the residual of purchase accounting, goodwill. We'll start with organizational costs. Org costs are the costs incurred to organize an entity, for example, a corporation or partnership. Most states have some statutes regarding the organization of a corporation, a requirement for articles of incorporation, stock certificates, corporate bylaws, a board of directors, etc. Costs can be incurred to set these up. Even LegalZoom charges about $250 to set up a simple California corporation. Obviously, the larger the corporation, there's a pretty good chance these costs are higher. In any event, the general rule for org costs under the tax law is to amortize these costs over 15 years, 180 months. However, to reduce the after-tax costs for small businesses, up to $5,000 can be expensed in the first year. So again, we have to cross the same old bridge. What does it mean to be a small business? In this case, if the org costs in total are less than $50,000, you qualify for the $5,000 expense. As usual, there is a dollar-for-dollar phase-out for every dollar of org costs in excess of $50,000. Whatever is not expensed is amortized over 180 months. Startup costs are pre-operating costs that are not org costs, such as the cost to investigate the plausibility of a new business. Note that if these type of costs are incurred for the expansion of an existing business, they're just ordinary and necessary business costs and are deducted. It's only new businesses or lines of business that have startup costs. In any event, the tax rules mirror the rules for org costs. Amortize over 180 months with $5,000 of expensing available. Okay, we need some examples, so this is where you might want to get that calculator back out. Let's look at Gobi Corp, a new corporation that started business in May 2018. I'm going to vary the amount of org costs, but our job in all scenarios is to compute the deduction for org costs. Let's start with $3,000 of org costs. Clearly, this amount is below $50,000, so up to $5,000 can be expensed. Since only $3,000 was incurred, that's the amount to be deducted. If we increase that to $5,000, the same structure applies. Less than $50,000 and up to $5,000 expensed, thus the deduction is $5,000. Now if we're up to $8,000 of organizational costs, well, we're still below $50,000, so we can expense $5,000, leaving $3,000 that must be amortized over 180 months. 3,000 divided by 180 times the 8 months for the period from May to December is $133 for a total deduction of $5,133. Note that amortization uses a full month convention, so we get the whole month of May regardless of what day in May we start. If we really increase the org cost to $52,000, then of course now we break through the small business threshold of $50,000 by $2,000. Thus, we must phase out the $5,000 by the same $2,000, leaving only $3,000 to expense. After we expense $3,000, the remaining $49,000 must be amortized. Thus, $49,000 divided by 180 times 8 is $2,178 for a total of $5,178. So Gobi Corp is in the donut shop business. If Gobi incurs $15,000 looking for a new location to build a new donut shop, this is simply an expansion of their existing business, and the $15,000 is deductible as an ordinary and necessary business expense. If, on the other hand, Gobi spends $15,000 investigating a new surf shop, then these are startup costs and must be expensed up to $5,000 as permitted, then amortized over 180 months, as we are used to. Note that if Gobi's venture fails and the business is never started, the $15,000 is not deductible. There are special rules related to the amortization of intangibles acquired as part of the acquisition of an entire business. These are commonly called Section 197 intangibles. Can you guess which code section defines them? That's right, Code Section 212. No, just kidding. Of course it's Code Section 197. So if Gobi acquires a business for $1 million, and the fair market value of the tangible assets is $600,000, then Gobi will end up with tangible assets of $600,000 and intangible assets of $400,000 on its balance sheet under purchase accounting. In this case, the intangibles are $100,000 for a customer list and $300,000 of goodwill. Both of these intangibles will be treated as Section 197 intangibles. The tax law stipulates that Section 197 intangibles are amortized over 15 years, again 180 months, regardless of the actual useful life of the underlying intangible. For example, it could be that the customer list Gobi acquired had a useful life of 2 years. That's totally not relevant for tax. 15 years, period. The same full month convention applies. However, most intangibles acquired not as a part of a business acquisition are amortized over their useful life, or remaining useful life, as the case may be. So if Gobi acquires a $100,000 patent with a remaining useful life of 7 years, the cost of the patent will be amortized over 7 years.
Hopefully you can see the similarities between depreciation and amortization. Of course, they're not identical. I guess that's what makes tax interesting. Thanks for watching video T7E.